Yeah, I mean, this is the main slide to get us started, right? This is the best information. So bringing that interest rate down from the early 80s in the teens down into the single digits. And then obviously what we saw is the housing crash in 2006. That was kind of where rates had leveled in and stuck around maybe 6.5%. And then they just started a nice slide down, right? A trajectory down to what was kind of the bottom there before the pandemic hit was in 2013, right? We had the best interest rates we'd ever really seen. Things were really rocking. People were buying houses. First-time home buyers were buying. People were investing in real estate. Like things were going great for, from 2013 through 18. In 18, we started to see rates tick back up. We started to see a little bit of a slowdown. And then what happened, rates started getting a little bit better. We were worried about it, some inflationary times or some recessionary times. So the Federal Reserve got ahead of it and lowered the interest rates. And then all of a sudden the pandemic hit. And then woof, interest rates hit rock bottom, absolute bottom there. But then you can see at the very right edge of this graph, they've spiked back up, right? In a very, very quick moment, we went from 2.75 to 5.5 in about 6 months, right? So, but the thing I like about this is it gives us the history, right? The overall history.
Sure.
This is basically that same graph, but condensed to the last 10 years. And the reason I thought that was useful is you can see we are at the highest point we've seen in the last 10 years, right? These are 30-year fixed average, vanilla flavored, and also includes 15-year and a 5/1 ARM as well. But these are good average interest rates nationwide, average borrower. This shows you, right? I mean, yes, it's been harmful. Like things have really rocketed up over the last 6 months.
Right.
This is what we call the mortgage-backed securities market, or MBS. This is a 2-year history of MBS, and you can see that there was a long period of time here before the Fed made their announcement in November they were going to start changing things. We were good. Like things were really good. And so from the peak here to the, I guess we call this the trough, right? The bottom, we lost 900 basis points in the MBS market, right? That is a really substantial move. And you can see most of it happened from November to May, right? Like that was a really quick window of time where things changed. But good news, right, is this is the last quarter. So the last quarter, we've kind of seen a leveling out, right? We're always going to have little ups and downs, right? And that's just how the nature of interest rates go. They're a little cyclical, but you can see if you go back from here, June 6th, all the way back through April, like mid-April, even early April, we're kind of in this trading zone, right? So in between this blue line and this blue line, and that's centering into being a channel that's kind of keeping interest rates at this level. Now, any point in time, a piece of news can break out and something can happen, this war or this cut or this thing or whatever, like things can move that. But this is a welcome for us mortgage guys and real estate investors for that matter too, because things have started to level off and you can kind of know what to expect, right? There was a period of time where literally every week interest rates were going up 0.25%, right? And so I'd talk to somebody, we'd get them pre-approved, or we'd run some numbers on a property and go to lock it because now they're in contract and it'd be a quarter worse or it'd be a half worse. I mean, it just was moving very quickly. So this leveling out is really nice.
So, many investments or many agents are kind of reporting to us that their clients are asking if it's a good idea to keep investing right now with the higher rates.
Yeah.
I mean, as an investor, I say, look at the numbers. If the numbers work, and numbers will always work, right? So if the numbers work, continue to invest. What do you say? What can you say to agents to maybe help them with their clients?
Yeah, that's a great question. I would say that I'm still investing personally. I'm looking for deals. I'm a little more choosy for what I'm looking for. And the other side of the equation of not investing right now is if you are sitting on cash, you have to think about what's happening to your cash right now, right? And it's a good example is I've been talking to a lot of clients and investors about interest rates where they're at as a relative piece to inflation, right? And so you think about where inflation was 2 years ago at 2%, right? That was the Fed funds target rate, inflation 2%. And interest rates were at 3.5%, 3%. That means a bank can make 1.5% on a year lending out $100,000 or $1 million or $1 billion, right? And that you got to think about when you think about banks, they're looking at numbers that start with a B instead of $100,000 deal, right? Like they're looking at billions and billions of dollars they're lending out. And so if they've got billions and billions of dollars and inflation's at 2% and they're lending it out at 3.5%, well, they can actually make 1.5%. In today's market with inflation at 8.3% and a 30-year fixed rate mortgage going at 5.5%, they're actually losing money on inflation, right? So if they just let that money sit in the bank, they'd lose 8+%. Lending it out at 6%, they're still losing 2%, right?
Crazy. Yep.
So as an investor, I like to think like a bank as well, right? Like I'm gonna think, if I've got this cash sitting in the bank, do I sit on it and wait around and wait for some deal that may or may not happen? Or do I put it to work and preserve my capital, right? And
Great point.
If I don't put it to work, then I'm taking a risk and hoping that maybe something changes where I can get an even better deal in 6 months. And maybe that's true. But if a year goes by and prices don't go down, I've lost 8% on my money.
Right. Yep. If we could all have the crystal ball.
Well, 100%. Yeah. Totally. Dina, are you looking at that presentation? Can you advance it a couple slides? Which one are you on right now?
Yep, you betcha. I am on 1 year MBS history.
Yeah, so go to the next one.
Right? 1 quarter.
Yeah, so that's that quarter where I was saying it's kind of leveling out, right? And I apologize, I wasn't telling you in advance.
That's
okay. That's that leveling out that we were looking for, right? So let's go to the next one.
The evolution. Yep.
Yeah, so this is the evolution of a $600,000 house and what the payment has looked like and the price has looked like in the last 3-4 years, right? So you start out in 2019, you got a $600,000 home price, interest rates 4.33. That gives you a payment of $2,383. You can see the next year moderate home price increase. That was nice, right? Interest rates went way down, so your mortgage payment actually dropped for that same house, even though it's more expensive. And then the next year, right, the house went way up, right? Again, these are national averages on appreciation. So house went way up, interest rate went down, so the payment didn't change a whole lot, right? A little bit. But then you go to 22, and now home prices up even more, and rates really up, and you can see that payment has skyrocketed now, right? So from 21 to 22, that same house went up almost $1,500 in monthly payment because of that interest rate differential, right?
Hey, Cody, I was just told that our presentation is not sharing. I apologize.
Oh, shoot. Okay. Well, no problem.
Yeah.
We'll put it on the page so you guys can reference back. We can just have more of a conversation.
There you go. Okay.
That's no problem.
Okay.
But there's some really cool things that are in that are I think important to think about when we're thinking, do we continue to invest, right? Because that is a big question, right? Do we continue to invest in this market with prices up and interest rates up?
Right.
What's going to happen, right? So one of the other things that leads me to, I still think it's a reasonable time to be an investor is the number of homes that we've built, right? So there's going to be a great slide in there about that. And the number of homes that we built by year in 2000, 2005, 6, 7, 8, and even a bit in 9 were really, really substantial number of homes, and we were holding to the market. Then we had a correction in the marketplace, right? You had builders that went out of business. You had people and companies that lost homes to foreclosure. And then the resulting factor was we built way less homes, well below the 50-year average for 13 straight years. And so it's widely held that there's probably about a 4 to 5 million home differential between what we need in the marketplace and what we've built over the last 13 years. And so with that said, then we look at supply and demand, right? So if I've got a limited number of something, whatever the widget is, and I've got more and more buyers for that thing, the price, generally speaking, goes up, right? And so while interest rates are climbing, maybe we'll see a slowing of the increase in value of homes, but the fact remains we have a big shortage in this country, and we don't have enough homes for the people that also, well, real quick, I'll make this point and then I'll let you go.
Yeah.
There's the number of homes we've built, but then there's also the number of household formations, right? And so household formations are when, let's say I've got a kid and they're going to go off to college, they graduate, and then now they're going to buy a house or want to own a house, right? That's one
Yeah.
extra household. Unfortunately, divorce happens, right? You go from one household to two now. You've got immigration, right? So people come here from Canada, they come here from India, they come here from Europe for seeking a better life or jobs or what have you. That's more people here now that we need to house. And so in the same time, we built 13 years in a row that we built fewer homes than the national average for the last 50 years. We've added 14 million households. So not only have we not kept pace with the number of houses we were building, we've added more households that need a home as well.
True. I was going to ask you with retail buying right now, are you seeing a shrinkage in that?
Yeah, I would say that there are less people that our market is less active, right? Obviously, refinancing rate-driven refinances are almost off the books, right? Like if you're
first-time home buying probably is affected drastically.
Refinancing to save money at a 5.5% rate, then you were doing something wrong the last couple of years, right?
Yeah.
Now we still have purpose-driven refinances, right? Cash out refinance to pay off debt, cash out refinance to free up money for down payment on an investment property, whatever it is, right? So the purpose-driven refinances are still there, but a lot of that business is gone.
Right, which actually is good for an investor, right? Because it's going to take less people out of buying the homes and putting them into renters.
Yeah, absolutely. Yeah. So there's a couple things. It's good for it. The number of refinances we did over the last 2 years was bonkers, and it gummed up the system too, right? I mean, you're having to wait 30, 45, 60 days to close on a deal, sometimes 2 or 3 or 4 months on a refinance. Now, I mean, a 30-day close is cake. A purchase, typically we're closing in 21 days. Refinance is 30 days, no problem, right? Appraisers are no longer in such high demand that they can command crazy prices, right? So things are normalizing, right? This is kind of what we've been asking for the last few years, right? It's a normalizing.
Much needed. Yep.
Yeah. But to bring your point, though, I do believe that there will be fewer home buyers because of, well, two things, right? We've had a big stock market correction, right? So the stock market's off 20 to 30%, depending on what you're invested in. Some stocks are off like 50 to 80%, right? So if you are a company guy at Snowflake and you wanted to buy a house, well, you might have just saw, 30, 40% of your value in your company stock go away. So maybe you're not going to invest. Same way, Microsoft's down 25%, Google's down 30%, right? So a lot of our executives and higher earners in our area are putting pause on buying right now because their stock prices have been hit so hard. Sure. Now on the lower end, maybe not stocks infecting them, but interest rates are affecting them, right? Yeah. And so the down payment assistance program was at 3% 6 months ago. It's at 6.25% today, right? So if you have no money down, you're paying 6.25% on that rate. So that affects how much you can buy, right? And so and in Seattle, right, our marketplace where I'm at, the average first-time homebuyer home is like $600,000. And so if you go from a $600,000 home to only being able to afford a $400,000 home because that's the cut that you have to make because of where rates are, well, there may not be a home available, right? So you have to rethink. You got to go further out. You got to, raise your budget, what have you. So because there will be fewer buyers, that means there'll probably be more renters, right? Yep. And we saw this one time already in 2006 when the market corrected, right? We had a lot of people that lost their houses, unfortunately, but those people now they're not buyers because they just lost a house to foreclosure or short sale, and they're not, so they're renters, right? They're not, and they're no longer homeowners, so they must become renters. And so when we saw an influx of renters that we didn't have before, and then a shortage of housing because, man, oh man, you don't think we're building houses now, but I remember what it was like in 2009. Like there was literally swinging hammers, right? Like the only thing that was happening was like maybe a bank paid a builder to finish out a project that was sitting,
and then that was it going.
Yeah, and that was it. Nobody was starting anything new, right?
Right.
So there was really not any new houses coming on. And if you just lost a house, you were for sure a renter for at least 2, maybe 4 years. And so I think we're going to see a return to even more renters going forward.
Yes.
The affordability crunch.
Yeah, I agree. And I think that will also, with demand comes increase. So I think for us landlords, we'll be able to keep the rents up there and maybe increase the rents because the demand's going to be there.
And that's one more argument for buying right now, right? Like you may feel like, well, the prices are high and the interest rates are high, and rents maybe haven't quite caught up with it yet, right? Because we're still in this inflection point. This has only happened over the last 6 months. So if you're not seeing rents rise yet to the level I think we're going to see them in new renewals, there's definitely going to be, like, I've got a ton of people that rented from me over the last couple of years, and they all said, well, we want to buy someday. I'm like, okay, great. And I told them, like, if you're renting from me and you want to buy a house, I'll do your loan and you can get out of your lease for free anytime you like, right?
That's awesome. Yeah.
These people are like, hey, I need to sign another 1-year lease because we're not buying it, right? So,
right. Well, we're still coming off of the COVID where people couldn't raise rents too. So yes, we are definitely under rented, I think, in a lot of areas.
Yeah. And so that's going to make a marginal deal today look like an even better deal tomorrow. And then, the tomorrow is coming soon. And then I believe there will be another bite at the apple for a refinance market, because I feel like this is based on my history and what I've seen. The Fed typically overdoes it, right? They overdid it with supply by pushing interest rates down, right? We didn't need interest rates as low as they were, right?
Right.
Nice.
Right.
Don't get me wrong. I liked it. We did a lot of refinances. I got a lot of great loans personally, but they didn't need to be as low as they were to encourage growth. So they overdid it, right? And now they're overdoing it again on the way back up. And we will see the ramifications of that. We will see a slowing, and we might see a little stall. And then we'll start to see them lower interest rates again to keep the things going again. It's what happens, right? They raise their interest rates. So if you secure today and rents go up and rates come down, well, all of a sudden now you're making really good cash on cash return.
Yes. Awesome. Do you have more that you want to cover, Cody, or do you want to chat? Go ahead.
There was one other thing. This will be hard to envision without the slides, so I apologize. We'll get that on the Facebook page. But it's an inventory build, right? And so there's a lot of talk right now that inventory is way up, right? Inventory is going up. But what I will have people remember is inventory always goes up this time of year. This is the spring buying season. This is when people put their houses on the market. Their kids are out of school. It's time to move, right? This is typically when we see the highest levels of inventory throughout any year over the last 25 years. But what I will tell you is, as that rate, it goes up and it goes down, right? And so you see the spring buying season goes up, and then you get more into the later months of the year and it starts to go down. But what you'll see is it's continually going down. Every year that we've put in a new high, right? The high this year is lower than the high last year. And the high last year was lower than the high previous year. And we've been doing that for 10 straight years, right?
Yeah.
In 2006, kind of the height of the crunch, we had over 4 million homes available for sale in the country. Right now, there's less than 1 million homes available for sale in the same height of spring buying season.
Wow.
Yeah.
Interesting.
Yeah, so that's one of those things that I really love to talk about, in the sense that, yes, it's higher than it was 2, 4, 5 months ago. But if you compare the number of homes available for sale June 7th, 22 versus June 7th, 21, it's less this year than it was last year. And there are price, you're seeing people, like, I've seen a number of people post about price reductions. That's absolutely happening, right? There's a ton of price reductions. But what I will tell you is it's because of how the home was priced to start with, right?
Right. We were definitely overpricing
when
houses.
you look at what had been happening for 2 years straight now, right? We saw a home sell for $500,000. The next home was listed for $550,000, and it probably went for $560,000 or $570,000 or $575,000. So what happens? Well, the next house to list in that market
drives higher.
List at $600,000, right? Well, hey, we might as well hit and that one's furious. So, it sold that one. Oh my gosh, I better get one. This one's listed at $600,000. I'll go to $650,000, right? And then okay, well, $650,000 is the new mark, and I want more than the last guy, so $675,000, right? And so we kept seeing that happen up and up and up and up. And now what we're seeing is if the last house in the neighborhood sold for $9,000, we're going to list it for in let's say it sold for $9,000 in December, right? In March, we're going to list it for $1 million. Well, unfortunately, what sellers and some agents don't realize is interest rates have totally changed. The buyer metric has totally changed. So now that $900,000 house today, in today's interest rates, costs $1 million, right? Like it's the same cost as $1 million. So now when they list it at $1 million and I have to pay higher interest rates, it's like I'm paying 1.1. So I don't want to, right? And so now I'd rather, I don't want to buy that house at $1 million. I want to buy it at 900. And now the sellers and the less informed listing agents are freaking out a little bit. And they're like, well, gosh, what do we do? Well, I think what you have to do is I think you have to go back to Q4 sales numbers or Q1's listing numbers. And that's what you're going to list for, right? So if a house listed in Q1 for 900, it probably sold for $1 million. Doesn't mean you can list it for $1 million today. I think you need to list it for 9.
Right.
And I think if you do list it for that house for 9, I think it sells at 9. Right. I'm seeing plenty of homes sell right at list, maybe a little over, a little under. But if they're overpricing based on the crazy spike that the market was in, they're missing the boat and they're not going to sell.
Well, and their buyer pool is so much smaller right now than it was at Q1. Yes.
Yep. And the other thing to think about too, I was in a room full of realtors the other day, and I said, who's been in the room more, or who's been in the market for more than 5 years? And it was like nearly crickets, right? It was a lot of newer agents. And I said, do you guys realize that in the olden days, 5 years ago or more, it used to take 30 days to sell a house.
Right.
Right. And they're like, what? You know, because these guys, the only experience that recent sellers and recent agents have seen is homes sell in a weekend. Right.
Right.
And sometimes with 30 offers. Right. And that's
the reality is very different. Yes.
That's not a normal market. Right. There was an abnormal market, and now we're returning to a normal market.
Yeah. Well, Cody, I'm so glad you came on. One last question I have to ask you, because so what do you have? 168?
138 at the moment. Yeah. I sold the building to buy a smaller building, right? A luxury house instead.
Oh, your beautiful short-term rental. Yes. Yeah. Okay. Awesome. And I'm just going to ask you, I know the answer, but I'm going to ask you for the benefit of anybody watching. Are you still buying?
I am. Yeah. I'm actually in mid-process of a 1031 exchange. So I'm looking to sell, or I'm in contract to sell a property in Oklahoma, and I'll be looking to move that to a market that I like a little bit better. So yeah, I mean, again, a little more choosy, but I recognize the value of putting my money to work and not leaving cash in the bank. Like, that just burns me, man. I do not like to lose money, and losing 8+% to inflation is a scary deal to me.
Right. I 100% agree. And I think that's the key thing, right? People have bought real estate for centuries. Real estate works. It always works. And the key is not being emotional about it, looking at the numbers and seeing if it's going to fit.
When typically I buy for cash flow as well, right? And so I'm looking for a long-term cash flow investment. And so if I buy something today, I think the only reason you wouldn't buy something today is because you think the market's going to correct and the price is going to go down. Right. That would be the reason. Right. Because if you buy something today and rates are high and rates go up, well, you're happy you bought. If you buy something today and rates are high and rates go down, well, great. You'll refinance. Right. No big deal. Yep. If you buy something today and the values keep going up and the rates keep going up, then again, you're super happy you bought. But if you buy something today and the values go down, that's what the only one of the 4 scenarios where you're like, oh, I'm kind of bummed, or I'm upset. And that's true. Right. But here's the thing. Like, I started investing before the market crashed last time. And what I did was I bought every time I could as the market went down and as the market went up. Right. And so I dollar cost averaged into the real estate market, which is a little harder to do than buying a couple shares of stock. But you can do it, right? If you've got some money to put to work. So
I love it.
I have $1 million to put to work. I would say buy one house now, or one fourplex now. Wait 6 months, buy another one. Wait 6 months, buy another one. I would not dump it all in the market today, because I think that would be not a great recipe. If you have enough money to buy one property, I would still be looking for the right property to buy today. And I would look like heck to raise more capital and be able to buy again if it goes down. But here's the thing. We don't buy real estate because it's temporary. We buy it because it's permanent, right?
Amen. Yep.
Investment, right? We're putting this money to work long-term. And so if I'm in a house and it goes down in value for a year or two, well, I'm okay, right? Again, I'm like, hey, okay, let's buy another one. Let's buy 2 more, right? They're on sale. If I liked it at 400, I love it at 300.
Right.
Right.
Yes.
So
yes.
You keep buying, and then you're looking long-term. You're looking 10, 20, 30 years out. You're going to do great in real estate.
Awesome. All right. Well, I really appreciate you taking the time with us today, Cody.
My pleasure.
Great to see you. It's been a while.
Good to see you as well. Thanks so much.
All right. Take care.
All right. Bye-bye.
Bye-bye.